It's Wednesday the 19th of November, and this is a brief market update from AHDB HGCA. Markets continue to be very interesting and continue to be very volatile. As the graph here shows, we're currently in a period of a 6-week price rally on the UK feed wheat futures, really in the nearby position, although that rally feeds through to the new crop position on November 15, which increasingly more and more people should be becoming aware of. It's difficult to know really precisely what's driving the price rally, but the catalyst to my mind has been a reluctance of the world's farmers to part with grain at these much lower prices than what we saw pre-harvest. Also, we see some very early weather impacting the condition of new crops, although we have to bear in mind that this could well be too early to really use this as a firm driver of price. But also as well, after we've seen the one-directional nature of the very bearish market, we've seen an adjustment in funds and other participants really reducing back their short sold positions, taking more of a neutral stance, and that's just added a little bit to the rally as well. This week we see this rally easing. Actually, to date we've seen prices moving a little bit lower, and certainly with the May 15 futures really starting to test the £130 a tonne mark. So there is a risk that this rally could be lost, and this rally is really very useful especially to farmers that are adopting very much a post-harvest selling strategy. Is largely because the market is currently some way ahead of the current post-harvest average since the 1st of August, and with the market there's a good opportunity to maybe strategize and get a position which is ahead of that current average. Putting all this in perspective, in terms of the marketing period, if we consider the post-harvest period from the beginning of August to the end of June, we're actually around a third of the way through that period right now. So anyone benchmarking, anyone marketing to essentially beat that post-harvest average should be looking to be somewhere in advance of a third, maybe even a half sold by this point. The focus really I wanted to put on today's video is to look at how well the UK is doing in its export programme. This is a big year for exports, an important year for UK grain exports, and it's really a double-sided affair. The graph on the left here looks at cumulative wheat exports, and so far this season UK wheat exports, given the size of the crop, have actually struggled somewhat. We would expect, given the size of the crop for exports in a normal year, to be in line with that green line, the benchmark year of 2008-9, where we had a similarly sized crop. But at the moment we're struggling to maintain, to build that pace, and so that slow export pace so far is quite concerning. So to avoid a massive build-up in wheat stocks in the UK market, we need to see a tick up in the export progress. Not impossible, but the likelihood is that we should expect to see higher stocks in the UK market this season. Is that a complete disaster? Probably not. Early indications from the early bird survey that we published last week suggest that the UK is looking at a wheat area down by around 5% as farmers move away from wheat in some parts, maybe favouring winter barley to meet obligation of the 3-crop rule, and using spring barley as an approach to try and deal with blackgrass issues around some parts. On the barley front, it's much more of a success story in terms of exports, really continuing the success of last year, 2 big years of production in 2013-14, and so continuing that need for a very aggressive export program, so very much in line with where we were, and that needs to continue. And really the difference of fortune between what we're seeing in barley exports and wheat exports really explains the fact that we have a relatively narrow price spread between the two commodities on the farm. One of the key aspects of the export market at the moment, or one of the drivers for the export market, is indeed in the fundamentals of the supply and demand. The world typically has a reasonable amount of wheat around, but for barley is quite unique. The global situation is almost in a deficit situation, stocks are quite low, and Europe is actually quite a go-to place for anyone wanting to buy barley. Currency is also having an impact, as we show on this next graph, and sterling has really had 2 fortunes against the euro to start with. We've seen some relative strength, although in recent days some weakness has come back in that way, well support competitiveness into the Eurozone marketplace. However, at the same time, we've also seen some significant weakness of the pound against the dollar, really seeing some of the lowest levels really since September 2013. And this comes on top of big grain crops in Europe, big feed grain supplies in Europe, and is really forcing the UK market to consider non-EU exports, third country exports, more than it probably would normally. So on grains, where are we? Well, we've pretty much lost this one directional nature of the market right now. That's sort of encourage the short sellers in the market, the funds and so be it, to sort of reduce back, take more of a neutral stance towards things. It's too early to my mind for us to get too excited about new crop weather. We have to wait and to see what the winter provides and get into the spring before it becomes a true market driver, and so it weakens the case of this price rally. So just be very, very cautious about what we've seen, and don't necessarily assume that this rally is going to continue. It's very difficult to see the market returning to say £150 a tonne anytime soon, just because we've got this strong supply fundamental in the marketplace right now. Nonetheless, though, if we see lower prices supporting demand, but on the whole, stocks should be expected to grow. Moving on to oilseeds, and it's a very similar theme in terms of price trends, although we have now seen some stabilisation in global prices. Really, the big fundamental of a big European rapeseed crop, a big US soybean crop, that was the price adjusting drivers. That's what's pushed these prices somewhat lower. Now we're seeing some stabilisation in the prices. Crush margins look relatively good. That's supporting demand and has lent some support to prices as well. And unlike grains and the oilseeds, we could almost treat as being in a permanent weather market. Now the US soybean crop is pretty much made and known. The focus of the market is shifting very quickly to South America. That soybean crop now in the growing stages. Argentine plantings slightly slower than many would expect or hope for, and so we're very much in a weather market there for what is becoming an increasingly dominant producer and exporter of oilseeds to the world market. Do we need to be worried about crude oil prices? Quite possibly. This was touched on at HGCA's Grain Market Outlook Conference last year. You can get a summary of all of that on the HGCA Markets website. Really, these markets continue to be quite fast moving, information changes, and the need for independent market information is really, really important. That's one of the drivers behind why we've decided to produce a daily market report, the Grain Market Daily, and that's available via the HGCA Markets website, www.hgca.com/markets.